Ausbiz Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hi everyone, and welcome to the afternoon here on Ausbiz Live from our Barangaroo studios. You've tuned in to The Call. 10 stocks picked by you. I put them to two experts and we do all that in an hour. It's Friday the 12th of August. Yes, it's Friday. Into the week and into a pretty good week on markets. Are we starting to feel a change in sentiment? Let's ask our expert panel today. Junbei Liu from Tribeca Investment Partners, Michael Gable from Fairmont Equities. Afternoon to you both.
Good afternoon.
Junbei, quite a good week on the markets.
Absolutely.
Halfway through earnings season.
That's right.
How are you feeling?
We're feeling pretty good. So the result so far has beat expectations.
Right.
And the outlook hasn't been as bad as expected. Now, of course, the big news for this week is the CPI print in the US wasn't as bad as expected. So that means bad news is good news, right? So that means interest rate perhaps don't need to go up as much. And that has put a huge boost across a lot of potentially growthy stocks in the last week or so.
Right.
It just, there's quite a lot of optimism around.
Okay, so you run a long short fund though,
That's
so
right, yeah.
you don't care if the market goes down because you're investing that way anyhow. But how are you feeling at the moment? Are you going more long than short now? Is this, a lot of people have been saying, oh, this is just a bear market rally. Is it still a bear market rally? Or do you think the bulls are taking over?
Look, I think it's a bit early to call the bulls taking over, but I do think we have probably found the bottom somewhere. Now, as a long-short manager in this environment, it's actually interesting because we have had a bit of a junk rally. So for a lot of those junk stocks, the stocks that doesn't make money and, in that sort of space, they probably will come back just because it's not natural buying, earnings not really supported and all of that.
A lot of our experts have been saying if you've still got crap in your portfolio,
selling that.
Use this as a way to just clean it all out.
Absolutely. Right. Volatility is still going to come.
Say that.
Absolutely. And then just use this opportunity, buy the high quality stuff because they will keep going because I think the optimism is returning.
Okay. Michael, how are you feeling about the market and earnings season?
Yeah, very good. Pretty good. We went from a position a few months ago sitting in cash, letting it play out. And then as we saw in June, there was a bit of a capitulation there in markets where we dropped about 10% just in the space of a couple of weeks. Bond yields went to levels which suggested, sort of economy crushing interest rates next year. So it all got a bit too silly, a bit too bearish, and obviously everything started to recover since then. Bond yields have eased back. The CPI print this week is confirming that potentially there's a turnaround here. Whether that's the low or not, I agree. It's too early to say. Because there's still uncertainty as to what will happen with interest rates. We're still not sure how high they will go.
So you're still in cash? A lot of cash?
Oh no, we've been buying definitely in the last several weeks. So we're continuing to add to our portfolios, but I wouldn't be surprised if the market does come back for a retest, and that'll be the big test of the market. So if we could get a bit of profit taking in the next few weeks, but everything seems to hold in pretty well considering, then I'd be going back into the market.
So what have you been buying? Have you been buying the quality stocks or
mainly
back in growth?
Yeah, look, mainly, for clients we tend to buy top 200 stocks. So to rattle off some names in the last several weeks, Mineral Resources, PLS, some of those mining stocks, quality stocks like CBA, Macquarie, Goodman Group. So Goodman Group, REA, the type of stocks that were pricing very, very high interest rates are now starting to recover. So there's opportunities out there. But again, I think the next couple of weeks will be a big test, and I agree with June Bay about the rubbish. Stocks like Zip, stuff that doesn't make money, they've bounced pretty well in the last few weeks, but zoom out and you can still see it's there's not really much happening there.
It's a classic. I came across a mate the other day and said, Zip's up 100% or 200% the last 3 weeks. I said, yeah, but it's still down 90% from a year ago.
Yeah,
I know, it's incredible, isn't it? How fast they get there. But one thing though, you need to understand, like in today's market, there's a lot of small cap managers. They have benchmark, right, small ord. Yeah. So with that benchmark, and Zip is a part of the benchmark. When it starts doubling and tripling, it scares people. And so for those managers, they have to go out and force to buy to cover some of the underway. So, when they does start increasing so rapidly like that, you have a rush of buying just to, just so that they cover their risk. And this is I reckon that's what's been happening, because we saw the rally in July, and now you just have people going in just trying to cover their risk. Flat. They're not natural buying. So that's why you want to sell into those.
Okay. All right. Let's take a look at the stocks we're going to cover this first half hour. New Hope, Lovisa, the retailer, that will be an interesting discussion, because if you should be buying quality, are they quality retailers? Because they've been smashed over the last 6 months or so and really haven't recovered that much. Australian Clinical Labs, Family Zone, Cyber Safety and Macca. Take a look at stock of the day though. I thought we'd look at Resmed. Fourth quarter figures of the stock out today. With its fourth quarter results, solid sales and profit growth, the latter appearing to be ahead of the market's expectations, reporting quarterly adjusted earnings of $1.49 a share. Revenue rose 4.4% on a year ago. Key driver of its strong full-year growth was the US, Canada and Latin America, which supported this with a 7% increase in sales. We sat down earlier with Resmed Chief Executive Mick Farrell. Let's see what he had to say about the company's outlook. Mick is a bit mute there, but we'll see if we can get that back on a little later. But share price dipping a little bit today. Jumbe, Resmed, one of our great medtech companies, is it? You put it up there with Cochlear, CSL,
Absolutely.
Resmed, don't you? What did you think of the result?
I thought the result was fantastic. Obviously, stock has rallied hard into the result. That means the expectations was very high, but still they managed to meet the expectations. So great result. And the outlook, if anything, it has been actually really, really bullish. They don't expect the key competitor, Philips, to come back to the market for at least next 12 months because of some of the regulatory issues. And that's actually better than expectations. Right. Most people expect 6 months they will be back. And they actually literally saying they just couldn't keep up with the demand. They're just selling everything they've got. And the backlog in terms of demand is massive, and then they are expected to increase their production quarter on quarter over the next many quarters. So, and that the consensus number is way too low. Just on the result itself, we expect probably 2% upgrade, and then overall the next year we should see a bit more upgrade coming through. Great stock, it was down 5.5% initially when it opened. Everyone should be buying at that price. Clearly now it's recovered a little bit, but it's just a quality stock that will good earnings growth. Very defensive.
Would you be buying at these
Absolutely.
levels?
Yeah.
Okay. Of course, Resmed, the big sleep apnea manufacturer, and as I said, the big four with CSL and Cochlear and Resmed. What do you think, Michael?
I have the same thoughts. So we like the company. We've got clients holding it.
Even at these levels?
Yeah. Look,
on the 5-year chart there, it's sort of still close to 5-year highs, isn't it?
I think we looked at this one on the show when I was here about a month ago, and I pointed out that what was really interesting about the way Resmed trades, obviously because I'm looking at the charts a lot, was it bottomed in May. The market bottomed in June. So despite that capitulation in the markets that I spoke about a few moments ago, Resmed just kept powering ahead. So that just showed a lot of good buying support, and that initial dip this morning on a result that didn't knock it out of the park in terms of expectations. They were merely sort of met. I mean, that's good enough in this market. So as Jumbo said, it was down 5% this morning, but it's already recovering. So again, we're seeing that buying step in.
Right.
So very positive sign for the stock, and I think it'll just continue to meander higher from here.
Okay, meander higher. So
Yeah.
is it a buy?
I'd buy it here.
Okay, all right.
I think one of the things they've done different structurally should be better is that they have probably structurally taken share from Philips now that
Right.
Philips has such a big recall, you know, a lot of and those structural share was never in people's numbers, so it should be at all-time highs.
Okay.
You know, just in terms because it's structurally changed.
And when competitors like that go through a recall, it does affect confidence in their product going
Absolutely,
forward.
and now there's regulatory
that's another
review.
advantage.
Yeah, that's right. And now the FDA is a bit worried about the competitor new product that's coming out, whether it's okay.
Right.
So you know, so it does take time and confidence for people to come back in.
Okay.
And structurally, you know, you just build your momentum,
All
getting
right.
share.
Let's get into the stocks that you want us to take a look at. And first up, Lydia wants a view on New Hope Corporation, the big thermal coal miner. We'll take the ESG filter off of this because everyone's ESG filter is very different. So we're just looking at this from a purely investment point of view. Michael, what do you think of New Hope?
It's done really well, and I think part of that is because everyone has this ESG filter now and they ignore it.
Yeah.
Whereas since the start of the year, there's been solid buying in this business, because if you ignore what's trendy and ignore the narrative, the fact was we were going to need coal, and the prices were going to go up, and they have been going up, and the share price of New Hope's been going up. It's more than doubled. So look, it's got a nice trend to it. I think it's hard to predict at what point coal prices will start to taper off, in terms of where the demand might sit over the next several months. But looking at obviously the trend there, I'd be happy to stay with that trend and the obvious demand for coal, and it could probably continue to surprise to the upside, because unfortunately, because of the ESG filter, there aren't as many buyers coming in and pushing it up to silly levels. It's got a nice sustained trend because some people are still ignoring it. So I think it can continue to push high.
Okay, so 5-year highs at the moment. Would you be buying at these levels?
Yeah, I'm happy to buy a stock at an all-time high because there's no trapped sellers above me. So I think it can continue higher. Happy to buy it here.
All right, and Jumbo, they are money-making machines at the moment.
Absolutely.
This and Whitehaven.
Absolutely.
And Terracom, which is a smaller one. Thermal coal, don't get mixed up with metallurgical coal, because that's very different. So not all coal miners are the same. But what do you think of New Hope?
Look, I think, I think those companies, remember, it's the you only hold them for a period where coal price is great, and and then when the global growth slows down and things will become tough. So, but if there's a time that you would hold coal company, it is now.
Right.
Things are going so well for those businesses. Their just demand is enormous. One part of the reason, part of the big reason is actually, when Russia and Ukraine conflict took place, we saw the spike in energy and LNG prices, right? And same as coal prices. Now the problem, but what we've had found since then is that Russia continued to ship, some of the oil to elsewhere because you can. Whereas the coal, Russia being a big producer in that part, they can't ship them. It's much, much harder. So that's why you have this chronic shortage at this point. We already have a shortage, and now they have a shortage because no one's buying things out of Russia. So the coal prices are holding very strong, even though the oil prices come off a little bit because oil is moving around and things. So so that does underpin quite a lot of demand for the short term. Look, if I hold it, it is absolutely, or if I hold it now, you're absolutely holding it. It's a bit harder to say buy because, the minute share price moves, where the coal prices started moving around, it can collapse quite quickly. There's no additional buyers.
They're going to be good dividend payers.
It'll be massive dividend.
Will be
pay.
massive
It'll be
dividend.
enormous, yeah.
Okay. Gaurav Sodhi from Intelligent Investor, he puts the argument that coal is a broken commodity, that when commodity prices reach a peak, that encourages more supply to come on the market and then it trends down again. The reason coal's broken is there will be no more supply. No bank will finance a new coal mine, no government will approve a new coal mine. So for the next 10 years, as the world moves across to renewables, even uranium, which is, could uranium actually deliver as an investment for the first time in ever? They're going to need coal.
Absolutely. So this is the thing. There's no supply coming on. There's no investment into it. It's going to put a lot of pressure on coal. But also,
and that will keep prices high.
It will. But do be very mindful that people who can invest now, it's getting harder and harder because of the ESG lens.
Right.
So, there's like literally any institution, they will go through all their managers. They will be saying, okay, what are some of the things you have in the portfolio and how do you reach that target in 5 years and with, clean portfolio sort of thing. So your investor group will shrink and shrink. So I really think the people who can make money is really individual investors, where your horizon is quite short and you can make good.
So more than anything, rather than capital gain on the share price, they will just be massive dividend payers because they've got to do something
because
with the
they
money.
can't exactly they can't invest and or they can't buy.
So you're buying for dividend rather than capital
it's
gain.
a cash flow business.
Right. Okay.
Eventually they'll go private. My view is you go private, and the private capital where it doesn't require public scrutiny will be able to take those private. They shouldn't be listed.
Okay, so private equity groups will start taking them on. Okay. All right. Jason wants a view of Lovisa, the big retailer in, it's not to be disparaging, but sort of costume jewellery. Tribeca. Well, that's even more disparaging. But cheaper, low-end jewellery. Michael, what do you think of Lovisa? And retail as a whole, both of you are saying it's time to get back in quality stocks, but all retailers have been absolutely decimated in the last 6 months. They're on incredibly low PEs, including Lovisa. Is it time to get back into the quality sort of retailers because the chances of a recession, the doom and gloom of 5 weeks ago, we're going to a recession. Doesn't look as though it's going to eventuate. Mind you, I don't think it was a long time since I did economics at university, but you can't have a recession and full employment, I don't think. What do you think?
I suppose if we had this conversation a month or two ago, I'd say yes, but the share price has lifted from about $13 to $18.
All right.
So I just think that maybe the risk reward here is a little bit too difficult for me to be buying it. The chart's got, there's still momentum there and it might continue to increase. I'd be happy as a holder. It's a good business, even though their margins aren't great. I just wonder, I'm not a buyer of jewellery, of course, but I just wonder if their segment of the market is a little bit.
I know on the weekend you have your nose ring or your earrings.
So I don't know. I just wonder if maybe what they're selling is a little bit too discretionary. That if we do end up with tough times in the next several weeks, that they may well suffer. Again, is that priced in or not? $13, $14. I'd be happy to take a swing and say, well, maybe it's gone a bit too south, but $18, I think it's not worth the risk.
So a hold. Given that, Jean-Bay, there used to be the lipstick index, wasn't it?
That's
when
right.
times are tough, people
play
would buy lipstick as
it.
a cheap reward when they couldn't afford anything more. So is Lovisa in that sort of mark?
Actually, it's in a different area, and I remember that was Mark McInnes from David Jones that said that. And also during the tough times, people like to look good, so that they're in the office and being noticeable. That's absolutely true. But retail, Lovisa is a very different area. It's young, it's exciting, it's going out, it's event driven. So when people go out, they buy some trinkets. It doesn't have to be expensive, just something looks nice for that particular event. And that's a huge market for these guys. And these guys really, during pandemic when all the events were shut, they couldn't sell stuff online, so because no one was going out. So this company will benefit this reopening thematic. Look what's happening in UK and things. Everyone's out. So this company,
because they are overseas, aren't they? Big push in the US,
and UK, and also at the same time, this company they not only trinkets, they exposed to the young sort of demographic. So so it's actually quite different. I think the consumer environment will be really tough in the next little while, just because how much we heard enough about it. It's going to be tough. tough. Now, so you want to be not mature retailers, retailers that rely on consumer to do better, to do well. And then these companies will probably have negative earnings and you don't want to be in there. Things like JB Hi-Fi, Harvey Norman and things. They're defensive and things, but earning will go backwards. I just don't want to be in those businesses. I want to be exposed to a more younger demographic, that they're spending their parents' money and that they also, and they're still living at home and they may not have the afterpay to, because the credit score is harder, but they still have money to spend. They want to go out. And also you want to be in retailer that's growing. So Lovisa is rolling out a lot of stores around the world, like 100 a year or something. And so, that just drive that growth. So even though it's amongst all retailers, it's a little bit more expensive, much rather to be in that one. Universal is another little one, they're rolling out. So again, it's that young sort of demographic. But that one's a little bit much cheaper and things. But look, discretionary income is going to be tough. It's just that you want to be exposed to one that's actually have organic growth coming through.
So would you be buying Lovisa or holding it?
It is. I'm holding it, absolutely. I hold it, and just buying additional money. It has rallied very hard into the result. Just tactically a little bit more cautious. Yeah.
So a hold, but your choice is Lovisa and Universal stores in retail.
Yeah.
All right, Miles wants a view, Junbei, on Australian Clinical Labs, the pathology services group that, like all pathology groups, made enormous money during the pandemic, shoving things up our noses to test us. And as we've seen, made pretty good margins on it too.
Incredible margin. Absolutely. And look, it's going to be tough. They made so much money and then they're earning the next
Huge amount.
And around the world, we've seen the PCR volumes drop to significantly, like 50%. So this company's earnings is going to fall a lot on that basis. So that's going to be very hard. At the same time, remember pathology companies, they never really have too much pricing power, right? Because they do big volume. That's why they also consolidate. Only a couple of large providers do it. Big volume, small margin, and then year in, year out. Now, in the environment where PCR tests, big margin is going to disappear, and then cost is going up significantly because, all these testing materials, things are going up, and they don't have pricing power. So I think the environment, not only the COVID hangover, the actual competitive landscape is going to get hard, margin's going to get hard. It's just very difficult. I would put, Sonic and a few, like Helios and kind of in that same bucket as well. Just
so you'd just be selling out of them?
Yeah, I wouldn't touch them.
If you hold them, would you?
I would sell it.
Sell?
Yeah.
Right. Michael?
Yeah, I agree. And we saw with a recent announcement, they've got issues with staffing, as any business does that has staff, and they're getting cancellations. So even I think the earnings visibility is quite poor. So that's another negative. And when I look at the way it's trading, I can see every time it tries to rally, there's some big selling, stepping in, big volumes. Not ideal. This thing's going lower by the looks of it. So I wouldn't be holding this.
So you'd be a seller as well?
Yep.
If you're in it?
Yep.
Did they make enough during the good times? Because I'm thinking they were slugging the government so much money and the margins were so good, and they were setting up in the car parks of shopping centres, so there's no rent, no nothing, just a big tent with a couple of people there shoving it up your nose. I'm thinking, God, they should have made even more money at those times, don't you reckon?
Yeah, I mean, I don't know. Yeah, do they invest it in a particular area, expecting this to just continue on for much longer than it did with the testing? And obviously everyone's got over it a bit quicker than maybe they thought.
Yeah, so they've made heaps of money, and then but the thing is, for every company like that, you just go, well, what do I do? Because it's not coming back. Next year it's going to be horrible. There's earning hole. We need to buy something. So I actually think company like that, you are washed with cash. Just go and buy things. Sonic, I think will well. They just need to go out and buy things. Unless you want to pay it out as dividend, but then you won't grow. You're earning. You buy something to plug that earning hole. And at the moment, I don't know, things are still pretty expensive.
And no, not me, but there seems to be this view: if you don't test, you don't have COVID at the moment. So, not quite the right thing to do. Michael, Andy wants a view on family zone cyber safety. This is the parental control platform to keep your kids safe on the digital platforms.
Yeah, I think previously on this show it was being discussed that it almost doesn't even work half the time. I think there's ways around it if you know what to do. I don't know about...
Yeah, that the kids, parents are saying, kids, we're monitoring it, and the kids are going, well, yeah, you might think you are, but maybe.
Yeah, I'd say that's a
always
big
work out a
problem.
way.
Yeah. If it doesn't work, where's your business case now? So, I don't know. I mean, when I look at the chart, it looks like something that's, okay, it's been smashed, it's lost maybe 2/3 of its value, seems to be breaking that downtrend. It doesn't look like it's making money. They keep talking about recurring revenue. I don't know. I just, a bit too hard for me. I don't know if it's worth it here. I think we're in a market at the moment where if you're not turning a profit reliably, it's, I guess to our point at the start of the show, it might then get sold off and replaced by the market with something that's actually making money. So I think it's probably still a bit of a risk here.
Okay. Isn't it funny when you go through eras of exuberance, it's all about revenues.
That's right.
Then a crunch comes that goes back to the really old-fashioned business model.
That
you've got to make money. You've got to have a product or
commercial
service that a
product.
customer will pay for, and you make a profit out of.
Absolutely. No, it is, right? Ultimately, it does
not that
come down
hard,
to
is
that.
it? Yeah.
People like you and me, we've seen the previous cycles,
Yep.
right? Like, ultimately, it still come down to the earning if you have a proper business model.
Yep.
This is a company, it's a rollout of loss-making businesses. So, they bought all these huge acquisitions, lots of challenges of integrating things. It was a thematic play. So during the bubble times, and it's in that cybersecurity, it's in that family, tracking and all that
Protecting
sort
your
of stuff.
kids.
Exactly, and they just attract a lot of interest, and ultimately need to demonstrate your scale. You're still not big, you're tiny, and then you demonstrate you can integrate those businesses and demonstrate you got a business model. We've seen how hard it is to actually generate a proper business model, like Life 360 in that tracking space, right? How hard it is to actually get people on board, charge them, and then do other things. Life 360 is much further down the track, and they've done all of that and demonstrated that they're really good at what they do. But this one is way too early in their journey. I wouldn't touch it.
Yep. Okay. Something a bit more conventional. Lauren wants a view on Macca, the Australian-based mining and civil construction company. What do you think, Jumbo Macca?
Yeah.
Is that mining services area a place to be?
Mining services, but this one's already under bid. And I don't think there will be another bid coming through. So I'll be just selling it and putting into something else. Just recycle your capital.
So take the money and run?
I'll just take the money. Yeah, it's done.
Michael?
Yeah, same. So when you've got these bids, there's, I guess, firstly the risk reward that the bid falls through, so it goes all the way back to where it was, or maybe you get a little bit more by holding on, and then there's an opportunity cost. So at the moment we've got a nice, faster moving market. There's opportunities. Why sit in something that's got a flat line? So for example, we bought some Oz Minerals 2 weeks ago, so I was very lucky with that one. But when the bid came in on Monday, we just said, look, just take it off the table and move on to something else. So I'd do the same with this one.
Do the same for this. All right, let's recap the first 5 stocks. Resmed, a buy from both Michael and Jumbo. New Hope, a buy from Michael, a hold from Jumbo. Hold for Lavisa from both. The recommendation on Australian Clinical from both is to sell. Family Zone, a no-go for both of them. And Macca, a sell as well. The call is tracking its own high conviction fantasy fund, which is picked by investment committee. The latest episode of the committee meeting is live for you to watch on ausbiz.com. Let's check in on the portfolio update. So heading into August, the committee decided to sell Ordinate and bank the profits. They added Oz Minerals as well, so that was a handy one this month. Also upped the size of the investment in Woodside. Let's see how the portfolio is performing. Since the 1st of March, the fund is up 3.7% on a cumulative return basis. Keep sending in your request to the call though, because the recommendations here will then be elevated to the investment committee. For example, Resmed will be put up to the investment committee. I think it's already in the portfolio as well.
Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit, and ready-to-drink cocktail brands.
Join us this afternoon at 3:45 for the last call as we wrap up the week. This half hour, we're going to be looking at Domino's, Brambles, Spirit Technology Solutions, Kip McGrath Education, Lifestyle Communities. If you could wish for a more diverse group of stocks, you wouldn't get any more diverse than that. So it's going to be fascinating. We're going to cover all grounds. All right, Dom. Not Don Mahaja, Dom wants a view on Domino's Pizza. Of course, the big pizza chain, but not only here in Australia, but New Zealand, France, Belgium, Netherlands, Japan, used to be Italy, but that was a classic, taking Coles to Newcastle, taking pizzas to Italy, but they pulled out of that this week, Jumbo, didn't they?
Absolutely. I'm surprised they thought they could make it.
Yeah.
Yeah, it's always interesting. On the hindsight, we always thought, oh, what were they thinking? And but at the time, we were sold of the story. It's like, oh, we can do better. It has actually been love going out.
Well, they
buying
took
Domino
pizzas
pizza.
to Japan
They
successfully,
did.
and everyone.
And France as well.
Yeah.
You know, and
Thought
France.
that was weird.
We're like, oh, French people love it. They're like, oh, they actually love pizza. You know, it's just interesting. But ultimately, it's about good business sense, and offer something that's different and good value.
Yep. Well, what do you think of Domino's now, though?
Look, I think Domino has had a bit of rally into the result. Result's going to be tough. There's going to be earnings downgrade. It is probably expected. Just, you know, the currency is working against them. Big part of earning come from Japan, and currency is very, very weak. So that's weak. And also we heard from just in Europe, all the trading is not doing too well, and Australia is not doing great. Cost escalation is significant because all the raw material, you know, food cost has gone up significantly. And as you know, Domino don't really have that much pricing power. You know, you can shrink the pizza only, you know, over time. You can't do it so quickly. Overseas, Domino's chain sort of report or indicate to pretty tough environment. So I do think this one is, you know, I'll be lightened just because it's sort of rallying into a result that is going to be pretty weak.
Okay.
Yeah.
So a sell from you.
Yeah.
Okay. Michael?
It was funny that a few years ago when interest rates were going down, Domino's positioned itself as more of a tech company to try to benefit from the big rally in tech stocks. Yeah, all the negatives that Junbei mentioned, I agree with. You know, the costs and so on. I think it'd be tricky to necessarily see a beat on this. It's starting to trade well. I mean, you know, in the last year it's had this horrible downtrend. But over the last several weeks, it does appear as though it's trying to break that downtrend. But I mean, it doesn't look like it's dirt cheap either. So, yeah, they really need to come up with something extraordinary, I think. And I just think the risks are
this time
are
last
too
year it
great.
was $165.
I know, that was ridiculous.
And now it's 70.
Yeah,
And it's still not dirt cheap.
that's right. I mean, I think they've previously guided for same store growth of 3 to 6%. They're only getting 2%. Yeah, I don't know what's going to happen in terms of those cost issues with ingredients, staffing. You know, maybe demand might taper off because those that buy Domino's don't have the money to spend on this. It looks like it's come back a long way, but it could, as we've seen with some other stocks this year, that doesn't mean anything. They can continue.
So
to
you'd
fall.
have it as a sell as well?
Yeah, I'd sell it. Yeah.
I think, you know, when it's close to $60, 60, 61, around that thing, that's buy mark. It's very clear. Yeah, so it's, you know, there's a, it will, I think it won't get to 60 because I think everyone's sort of waiting there with the 60. So it probably get to like 61, 62 is where, you know, you absolutely just jump in and buy it. And I think result is probably the catalyst because result is going to be a bit weak.
Right, okay.
Yeah.
All right, let's go from pizzas to logistics. And we have Parissa wants a view on Brambles. You've got WiseTech, which is software logistics. You've got Brambles, which is good old Chet Pallet. Michael, what do you think of Brambles? It's a bit more than the Chet Pallet, but it invented the pallet, which revolutionised moving goods around.
I mean, it's the share price is the same level it was 7 years ago. It's just been a poor investment. And you'd think that during that period of time, there were opportunities for it to actually do well. Why would it now do well with everything that's going on in the world? I mean, when we look at, some will recall that I think back in May we had There was an approach apparently from CVC, and that fell over within a day.
Yeah. That would be that
little
short spike up there.
Yeah, and what's interesting is it's now back at that level. So in some respects you could say, well, it's cheaper on a PE basis compared to historically, slightly, but the market's still pricing in a bit of a nice outcome here. And again, this is a business that, you know, we know about lumber costs are an issue. You know, if global growth slows down, that's a bit of an issue. I just don't really see much upside from here. Again, if it's instead of being an $11 stock, if it was back to, you know, $9, you could make a case for taking a punt, but not at $11.
Yep. Jumbo?
It's one of those defensive stock that doesn't grow as much, and it pays a bit of dividend, you know, sort of 4% dividend yield. Just doesn't grow much. The reason they had a rally is because they stepped away from the plastic pallet sort of, you know, investment, because that would have been enormous. Market just didn't like it, and then so they stepped back, but they're still investing a bit more money. Like you said, when they're during good times, they have to keep reinvesting, because it's a business that, you know, there's really not that much innovation, right? It's really just about, you know, you have to pour money back. Exactly. Yep. So ultimately, it's something that doesn't really move much. If market falls, this one is defensive. For me, I just wouldn't put my money in it.
Okay, all right. Would you put your money in Spirit Technology Solutions? Chris wants to know that, Jumbe. He says, especially when compared to a similar company like Aussie Broadband, which is really popular on the call, which it is, Spirit, when compared on revenue to market cap and EBITDA to market cap comparison, appears to be significantly cheaper than Aussie Broadband. What do you think of?
Yeah, look,
Spirit?
I think Spirit is, you're absolutely right, and it probably should be much cheaper. It is a company that it's a roll-up of all these telco and the services, and then, you know, it's a strategy. Management turnover was so significant in the last many years, and the strategies changed many times. It just sounds like a little Me Too business trying to buy out all those businesses, trying to be the likes of whether Aussie Broadband or someone else, and never really got to the scale, and never really have the management vision and team to bring it together. So, you know, it's a void.
Right. Yeah. And I suppose that's a good issue for Chris to consider as well, because you can just look at the numbers on these things, but the investment markets do look at the track record. If there's management uncertainty or management have let the market down, it actually takes a while to rebuild confidence, doesn't it? Because professional investors like you go, well, you told me that you disappointed me 3 years ago, you've got to work extra hard to turn me around.
Exactly. And remember, running a business, Tosha, you'll know, like running a business, things go wrong all the time. And you need that management experience and team to bring it together and know how to deal with crisis, because everyday things there's variables that you didn't expect to take place. And if you react properly, have a proper process, then you will do well. That's why management team is so important. And if you never really have the execution or, you know, track record, what makes people can, you know, believe you that you can do it. Yeah.
So it's more than just about the numbers, comparing it to a competitor, because the competitor, their executive team may be more highly regarded by the markets because they've delivered on their promises. So sort of an extra filter to put over it. Michael, what do you think of Spirit?
It's not a business I'd heard of, and when I went to have a bit of a look at it this morning, I was a little bit confused. I had to go back and try to figure out what really was going on. There was a divestment, and I just don't, for the same reasons, there's just a little bit too much going on there to actually say, yes, this is great value, or it's got a great prospects ahead of it. The only positive I will say for Chris, though, is in terms of the chart. I mean, if I'd been looking at this about a week ago, it's had this really nice technical breakout. You could have almost made 50% just as a little technical trade there. So, look, I think the share price is going to go up in the short term, but longer term, you could see it's still in a downtrend, and unfortunately, there's too much uncertainty around this. I couldn't be buying it. Right,
and I suppose, Chris, we should say here that the advice here is for more medium to long term investors. If you're a trader like Michael and Jumbe can do, they can be in and out within a month or a week of a particular stocks. Maybe there's some opportunities there, but for a mere mortal investor like us, you need a bit more skill if you're going to do all of that. All right, let's. Olivia wants a view on Kit McGrath education. This is basically the online tutoring business, isn't it? Not only here in Australia, but also the UK and New Zealand. What do you think of Kip McGrath?
As a business, I think it looks good. They obviously, with all these education businesses, we had that COVID period. Before that, they were doing really well, growing their earnings, and it looks like they're doing well again at this point. So I guess my answer's got a positive and a negative. I think the business looks good from what I've seen this morning. As a negative, there's just no liquidity. So for that reason, I can't buy something that only trades a few $1,000s a day because I'm the type of trader I am. I want to be able to get out if I lose more than a certain amount, and if there's no liquidity, that's going to be a problem. So for me and my style, it'd be no, but the business does look good.
Okay, all right. Jumbo?
Tutoring. I remember many years ago at the Song Conference, I think 5-6 years ago, I think I made the pitch about a tutoring company out of China. I was like, what can go wrong if you're ordering tutoring services to Chinese kids?
Oh, yeah.
It's the demand is insatiable.
Oh, huge. My daughter and grandkids used to live in Hong Kong. They would have bus advertisements completely covered with ads for tutoring businesses, because every parent wants their kid to be a genius, I suppose.
Oh, look, absolutely. And the pressure, right? If everyone else getting tutored, you got to get tutored. So, look, I think the thematic is good. Like, there will be more demand for it.
And here in Australia, it's getting
getting
more. That
more.
way
Especially,
too,
you start getting, So, parents will never tell you, but you know they're tutoring their kids. I so know they're tutoring their kids. And I may or may not have looked into those.
Oh, Johnny got an A, but you're getting him tutored. We know.
Yeah, that's right. I may or may not tutor my kid. But, so there's a lot of demand for those services. But the challenge is that it's about building scale. You're essentially, what's your competitive advantage? There's another online little tutoring company that's been around for quite a while and it's been doing very well. Share price decimated because it's an online business that burns cash. Is Cluey, CLU, and share price decimated because it's online business and then cash burn and things. But that one is very interesting as well. Look, I just think that sector looks good, but it's just at this point it's. You need to know, because the sector is still going through that proliferation early stage. You're not sure who's going to make it. And there's a lot of competitors just like these guys. So to me, I'm more on the side to see if the online guys can make it, and rather than, sort of more the actual centres. Right. Yeah.
Okay, that's
so
interesting, because last week, Cluey came up on the call with Claude Walker from A Rich Life and Luke Winchester from Merewether Capital, and they, for exactly those reasons, said no to Cluey. Put it on. They put it on their watch list. They did prefer Kip McGrath because it had a bigger scale and better track record if you wanted to be in that sector. But they had the same sort of reservations as well. Our final stock, Jumbe, Liam wants a view on lifestyle communities. They're in the business of retirement communities and retirement living.
Yeah, look, good company, good management, and then long-term thematic is great because there's just this shift into retirement living. And when people get to a certain age, it's not so much aged care; it's really retirement living. You don't want to be, you want to enjoy yourself. You want to be close to the beach. You want all these lifestyle that when you get to a certain age gap, and they love to do it.
And they're all downsizers.
They all
well,
downsize. That's right. And then they want the convenience as well. They want the cinemas. They want all these convenience. So it's actually fantastic. A lot of demand for those. Only issue is that the price. The retirement property is always linked to the underlying house prices, because the older people, when they retire, they sell their own house and then they put partially into the retirement living. So if your house is sold for a cheaper price, people might hold off a little bit because remember, you don't have to move in yet, so people might hold off. So it does affect the price of and the transaction level for those properties. So it's so much linked to the house prices, which is on the way down.
Right. Do you see a big crash in house prices though?
It has to come off though. So you look at the fixed rate. So last 2 years, fixed loan is 40% of the loan, right? And the fixed rate is going to roll from 2% to 6.9%. So this is from second quarter next year to third quarter, and that's big part of the home loan. Like, people just don't have that much money to pay for it, and then living costs is going up and things. So I think house prices at least should fall 15%, and 15%. We're talking about Sydney. Australia-wide, probably I think CoreLogic said the biggest fall it's ever had is like 8% across decades. maybe that's optimistic as well, because the interest rate has never been so low, and now we're
Yeah.
going to much higher. So potentially it will hit 10%. Sydney, Melbourne is just way more delta, right? Because price have risen so high than fall. But like 15% fall in Sydney price is taking us to April last year price. So it's not big. It's not. We're still in.
You've
we're
got to
not
keep
negative.
it in perspective.
Yeah, we're not in a negative equity. So people are talking about crisis and things. Look, it just go back to the normal level.
Yeah.
But it has to fall just to be more normalized.
Yeah, unless you took the Reserve Bank's recommendation the end of last year and bought in, and you've only been in 6 months, you'd be in negative
Exactly.
territory.
So absolutely.
Just out of interest, where do you think official rates will get? I was talking to Matt Common on ausbiz earlier in the week. He thinks with the easing of inflation in the US, which will come here as well, they're only looking sort of 2.6% as the peak of cash rates. Are at 1.85 at the moment, so it's not that much higher to go. I know other banks are around 3 or a bit over.
I do think we have to probably get to 3, because when you think about it,
okay.
inflation is not going back down below 3. Remember, our labour market still to catch up. Inflation probably settles somewhere between 5 and 6, right? So you can't have an interest rate that's below the inflation. So you probably have to get to at least 3%.
Right.
Maybe slowly, but we have to get there.
Okay. Michael, first up, lifestyle, communities.
Yep. Look, I mean, there's a bit of momentum in the chart. I'd be happy to hold here, but getting nervous. I think, again, back at $12, maybe there was an oversold opportunity then, but up here at 16, 17, because of the headwinds, property prices, construction costs and delays.
Yeah.
With that, I think that, the share price is, the risk reward just isn't as nice anymore. So it's not something I could buy up at these levels.
Okay. What's your view on rates?
So we've got, obviously inflation's a problem and central banks are talking tough on inflation, but I just wonder if we get to a point where that becomes the lesser evil compared to just destroying the economy and the housing market. So I guess I'm more on the side of rates won't go as high as maybe 3. I mean, I'm not an economist, but I guess my gut feeling is
the
that
sort of CommBank view that maybe 2.6% and then they'll...
And we're just going to have to deal with a bit of inflation, and maybe governments are happy to inflate their way out of their debt. I don't know, but it remains...
But a lot of the inflation's been imported, is it? It's not us going out
supply,
and spending heaps. It's just oil prices and supply chain and that sort of thing.
Yeah, and oil prices, as we know, are coming back, and there's a lot of soft commodity prices are back to the levels they were before the Ukraine invasion.
Yeah.
So maybe it's being optimistic that trend will continue. Who knows? There could be some other shock to the system, but look, I'm happy to admit I don't know. It is a very difficult situation.
Yeah, and the way China's talking about Taiwan at the moment, that's
absolutely.
That's another uncertainty, isn't it?
The share market is dealing with so much uncertainty at the moment. That's why the portfolio, make sure they're high quality. They're high quality. They've got your sort of structural growth leader, healthcare in there. They're not all small illiquid names, because they all get sold off. The minute there's a war breakout, they'll be down 50%. So just make sure it's high quality.
So you're overweight healthcare, are you?
Yeah, I do overweight healthcare, and then some of the growth leaders we sort of move back in the structural, like the things like WiseTech and things, because in this sort of environment you do want to be in the structural, like the growthy names, just because we don't know economic outcome. We don't know if there is a recession in US. We just don't know. And if there's a war, oh my goodness, there's just so much uncertainty. You want to be in leaders.
Yeah, absolutely. All right. Jean-Marie Luke for Tribeca, good to see you. Thanks for joining us. Have a good weekend. And Michael, great to see you.
Thank you.
Have a good weekend as well. Let's recap the final 5 stocks. Domino, a sell from both Michael and Jumbo. If it gets down to $60, $61, that's a sort of traditional buying level. Brambles, a no from both. Spirit, a no from both. Kit McGrath, a no from both. Gee, they've been grumpy on a Friday, haven't they? And Lifestyle, a no from Jumbo, but a hold from Michael. So that was sort of a bit of good news for lifestyle communities there at the end. Hey, if you've got any stocks that you want us to take a look at, email them to us, the call at ausbiz.com.au, or tweet it using the @AusbizTV handle. Just a reminder, you can find all the stocks in the calls portfolio. Head to ausbiz.co/portfolio. And don't forget to join us for the last call this afternoon. If you haven't joined us before, it's where we put our feet up, 3:45 Eastern, as the markets come to a close. We have a whole bunch of analysts and economists that come in for a drink, and we just basically gossip about the market and some of the big themes of the week. It's a lot of fun. So hopefully you can join us then. In the meantime, have a good weekend. See you for the call on Monday, midday as usual.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
It's like gangs that have decided that they're going to do something mischievous.
Particularly in ransomware cases, time is often of the essence.
Join me each Friday at 2 p.m, where we'll ask the big questions to the country's top cyber experts. Stream on ausbiz.com.au or on demand.
Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
Good afternoon and welcome to the Small Caps on this Friday. It's wonderful to be here with you. I'm Nadine Blaney. When we're talking about the broader market today, down by 0.6% as we move toward the final hours of this Friday session, and in the smaller end of the market, interesting to see the emerging companies index overall up by 0.1%, but the small ords is off by 1%. And that is why we're seeing these ETFs not looking to crash hot. Magnus Energy, I admit I don't know what the news is associated with that small company, and it's up by 36%, so likely some sort of an announcement. We've had a few viewers writing in lately asking about Satire. It's in that online e-commerce clothing space, but if we flip the page, we've got Avita Medical. So it reported today. I actually spent a bit of time with the CEO this morning talking up its strength of its balance sheet, but it had some test results come through today as well, and that has meant that it's come under pressure. It's a bit disappointing that Resell Control Group results coming through. Okay, well, let's get a little bit more analysis on what's happening in the small cap space, particularly when you consider we are in reporting season. It's been keeping us all quite busy. Let's get across it and start now. Welcome to the program. Really nice to see you.
Thank you very much.
Talk to us about, sorry, I've just got a computer problem here. Reporting season and your reflection so far. What sort of themes are you seeing come through?
Yeah, definitely. Reporting season has kicked off with its usual bout of volatility, and what we're also seeing is that investors are really having to grapple with wider macro uncertainty at the same time as well. So looking at some of the early results and how the share prices have reacted to those results, we've seen that the investors are really looking for recession-resistant growth. They're looking for companies like the likes of Pinnacle and Megaport that can deliver good growth despite a weaker economic backdrop. You've also, on the flip side, you've got investors willing to look through maybe some tougher conditions or headwinds for some businesses, as long as there isn't a balance sheet problem in the near term. So unfortunately, the likes of United Malt Group and Bega reported over the last 6 to 8 weeks, and whilst some of those issues may prove temporary, there can be a bit of a balance sheet issue with those. Mm-hmm. But obviously, it's really all about how investors are actually positioned going into each stock and as they report their result. If you look at Kogan, for example, I think that's a really interesting test case for the last 6 to 8 weeks. It's phenomenal what that share price has done.
Remember that day that it went up half, I think it was 50%
almost. Yeah. So really it was actually quite a disappointing print. But at the same time, investors were heavily negative towards the company. The short interest was quite high, and so you saw investors unwind those bets. So for us, we're actually quite constructive on the small cap market at the moment, especially the industrial sector. And we're looking for those pockets of extreme negativity or pessimism to take advantage of.
So there's been a lot of negativity, and you mentioning Kogan, Sam, has made me just think about the retailers. We had Baby Bunting today not providing guidance.
Yep.
The market has not reacted favorably to its results.